Alphabet just reported a single quarter of revenue so astronomical, like $109.9 billion, that it actually sparked their biggest stock rally since shortly after their 2004 IPO.
Yeah, it's a completely massive number.
Right, but beneath that huge headline, there's this glaring contradiction. They're making more money than ever before, yet their CEO literally just admitted on the earnings call that they are physically running out of computers.
It really is the defining paradox of the tech sector right now. I mean, we are looking at a fundamental structural shift in how the internet operates.
Exactly. So to everyone tuning in to this deep dive from wherever you are in the world, welcome. Today our mission is to look past those flashy top-line numbers of this Q1 2026 earnings report to understand the real financial drivers.
Right, because we need to examine the unprecedented physical infrastructure spending happening behind the scenes.
Yeah, and what this trillion-dollar compute crisis actually means for the future of AI, the broader market, and, well, everyday digital life for you listening.
Absolutely. Let's unpack this contradiction.
Let's do it. I want to start with the most prominent number on the balance sheet. So they reported a net income of $62.58 billion.
Which is huge.
It's an 81% year-over-year increase, and an earnings per share of $5.11. But I have to say, I am immediately skeptical of an 81% jump in pure profit for a mature company of this size.
You should be.
I mean, wait, did their actual search ad business magically double in 12 months, or is there an accounting trick here?
The skepticism is completely warranted.
Okay.
To understand that 81% spike, we have to look at their investment portfolio.
Okay.
Specifically, what are categorized as non-marketable equity securities.
Right.
Out of that $62.58 billion in profit, $37.7 billion came entirely from unrealized gains in companies Alphabet owns a stake in.
Wait, really? So we are basically talking about paper wealth.
Exactly. It's paper wealth. Alphabet has extensive venture capital arms and, strategic investments in private startups.
Ah, I see. So when the broader market rallies or those private companies complete new funding rounds at higher valuations, accounting rules force Alphabet to mark those investments up on their own balance sheet.
That is the exact mechanism, yes. It gets reported as net income, even though no actual cash changed hands from their day-to-day operations.
Wow.
It is a mark-to-market reflection of their investment portfolio's success. It's completely divorced from their core software and advertising business.
That is wild.
In fact, if you strip out that massive $37.7 billion unrealized gain, Alphabet actually missed Wall Street's earnings per share estimates by 1 cent.
Oh, wow, okay. Which completely shifts the narrative from, Alphabet doubled its operational efficiency to Alphabet's investment portfolio had a remarkably strong quarter, while the core business basically performed as expected.
Exactly.
Yeah.
But their operational core is still highly profitable. It's just that the 81% headline figure is heavily distorted by their equity holdings.
Got it. Now, before we move on, just a quick note for you listening. All the information and analysis we discuss here is just to help everyone better understand the market and is not investment advice. Investing involves risk, so please make sure to do your ample homework before entering the market or consult a professional financial advisor.
A very necessary disclaimer, yes. And speaking of understanding the core business, we also need to factor in the currency mechanics.
Right, because they are a massive global operation.
Exactly. Alphabet reported 22% overall revenue growth, but they also track something called constant currency growth.
Which landed at 19%, right?
Yeah, 19%.
I feel like the constant currency metric is crucial for global operators like this because Alphabet generates revenue worldwide in, euros, yen, pounds, rupees. They have to convert all of that back into US dollars for this earnings report.
Right, and when the US dollar is particularly strong, as it has been recently, those foreign revenues buy fewer dollars.
Makes sense. So the constant currency metric strips out that foreign exchange volatility to show us the actual underlying health of the business operations, which is that very healthy 19%.
Precisely. So if we pull back the curtain on the investment gains and account for those currency headwinds, we are left with a core business growing at 19%. And the engine driving that operational growth is undeniably Google Cloud.
Yes. Let's look at the cloud metrics because the acceleration there is intense. Cloud revenue hit $20.03 $3 billion for the quarter.
which is a staggering 63% year-over-year growth.
And operating margins jumped, right, from around 18% to nearly 33%, yielding $6.6 billion in pure operating income. But the forward-looking indicator that really stands out to me is their backlog.
The backlog is arguably the most telling metric in this entire document.
It nearly doubled sequentially, reaching $462 billion. I like to compare a backlog to a wildly popular restaurant's reservation book.
That's a good way to look at it.
It's money that enterprise customers have legally committed to spending over the next few years, meaning guaranteed future revenue.
Yeah, management specifically noted that over 50% of that $462 billion will convert into recognized revenue within the next 24 months.
To put that in perspective, a backlog like that isn't just a sign of popularity. It fundamentally changes how a company can operate.
It gives them immense financial visibility.
Right, because when a multinational corporation decides to migrate its entire data infrastructure and AI operations to Google Cloud, it is a multi-year, highly integrated process. Once that contract is signed, the client is deeply locked into that ecosystem.
And it provides Alphabet with the cash flow certainty to fund their own long-term capital projects. And, the main catalyst for this backlog explosion is enterprise AI solutions.
Which grew an insane 800% year over year.
800%, yeah. Alphabet is uniquely positioned here because they are offering what they call a first-party, full-stack enterprise AI solution.
Let's break down what full stack actually means in terms of a competitive advantage. I mean, they aren't renting processing power from a third party.
No, not at all.
Alphabet designs their own custom silicon. They build the physical data centers themselves. They author the foundational AI models like Gemini. And they develop the end-user software applications.
Owning every single layer of that stack theoretically eliminates the margins they would otherwise have to pay to middlemen.
Right.
It eliminates licensing friction, and crucially, it allows for deep hardware-software optimization.
Oh, because the software is written specifically for their hardware.
Exactly. When your AI model is written specifically to run on the custom chip you designed, you reduce latency and compute waste. And enterprise customers are just flocking to this efficiency.
Do we have numbers on that adoption?
We do. Alphabet reported that their Gemini Enterprise paid monthly active users grew 40% quarter over quarter.
What?
And they are currently processing over 16 billion tokens per minute via direct API use.
16 billion tokens a minute. That is a scale that really forces us to look at the physical reality of the internet. I mean, if enterprise AI is growing at 800% and cloud revenue is surging, there is an absolute physical limit to how much data can be processed by existing hardware.
Yes, and which brings us right back to that contradiction from the beginning of the show.
Right. To run this new digital economy, you have to literally build it in the physical world.
And this is the trillion-dollar infrastructure crisis facing the entire tech sector. Let's examine Alphabet's capital expenditure, or CapEx.
The numbers here are just mind-boggling.
They really are. They have updated their CapEx guidance for 2026 to between $180 billion and $190 billion.
And their CFO, Anna Ashkenazi, clearly stated that 2027 will see a significant increase above that.
Yeah. Spending $190 billion in a single year on physical assets is almost difficult to conceptualize.
They spent $35.7 billion in this first quarter alone. But I think the allocation of that capital tells the real story.
Exactly. Roughly 60% of that spend went directly to servers, specifically specialized AI compute.
While the other 40% went to the physical data centers and networking equipment, they are completely cannibalizing legacy compute infrastructure just to make room for AI processing.
And yet, despite deploying nearly $36 billion in 3 months, CEO Sundar Pichai stated on the call that Alphabet is compute constrained.
He admitted they literally cannot build data centers fast enough to meet demand.
He acknowledged that their cloud revenue would have been significantly higher if they could have actually met the enterprise demand.
Which introduces a major strategic paradox for me. If Alphabet is so compute constrained themselves that they are actively leaving cloud revenue on the table, why on earth are they choosing to sell their custom-built AI chips to other people?
You're talking about the TPU-8T for training and the 8i for inference.
Exactly. They are allowing select third-party enterprise clients to install these highly prized chips in their own private data centers. Why arm the competition when you are starving for compute yourself?
On the surface, it definitely seems counterproductive to export your most valuable asset during a shortage. But this is driven by their return on invested capital, or ROIC, framework.
Okay, walk me through that.
There are three mechanical layers to this strategy. First, semiconductor manufacturing relies heavily on economies of scale.
Oh, I see. So by producing a vastly larger volume of TPUs to fulfill third-party sales, Alphabet drives down the per-unit manufacturing cost at the foundry level.
Precisely. This makes the chips they keep for their own data centers much cheaper to produce.
So they are essentially subsidizing their own internal R&D and manufacturing overhead by leveraging third-party capital.
That's exactly it. The second layer is that these are not simple one-off hardware transactions. These are highly profitable, multi-year leasing and maintenance contracts.
Guaranteed recurring revenue.
Right. And the third layer is ecosystem lock-in. When a third party installs Google's TPU infrastructure in their own server racks, they are committing their engineering teams to the Google AI software stack.
Ah, so it serves as a Trojan horse. Even if the hardware sits in a competitor's building, the workflow and the architecture remain tethered to Alphabet's ecosystem.
Exactly. It makes the physical infrastructure play much clearer, and we see this aggressive physical expansion reflected in their recent acquisitions as well.
Yeah, they finalized the purchase of the cybersecurity firm Wiz for $29.5 billion, which is their largest acquisition ever, by the way.
And alongside that, a data center management company called Intersect for $5.9 billion.
Let's talk about Intersect first, because that acquisition directly addresses the compute constraint we just discussed, right?
Yes. Securing silicon is only half the battle. The real bottleneck right now is securing land with access to gigawatts of electrical power and industrial cooling infrastructure.
Right, because AI runs hot.
Very hot. So Intersect gives them vertical integration over power management.
And then the Wiz acquisition addresses the enterprise hesitation. I mean, as Fortune 500 companies migrate their most sensitive proprietary data into cloud environments to train customized AI models, traditional perimeter security just doesn't cut it anymore.
No, it's no longer sufficient. Wiz provides what Alphabet is calling agentic defense.
Instead of a passive firewall, it's an AI system that actively hunts for vulnerabilities and irregular behavior within the cloud architecture.
Which brings us to the defining buzzword of this entire earnings report, agentic.
Agentic workflows, yes.
We have mapped out the $190 billion in physical infrastructure in the enterprise software stack, but the only way Alphabet can justify that astronomical capex is if the end product fundamentally alters consumer behavior.
Right, to generate entirely new revenue streams, the internet is shifting toward these agentic workflows.
To understand the mechanics of an agentic workflow, think of it less like a search engine and more like a general contractor.
Right. Up until now, interacting with AI was like talking to an incredibly knowledgeable encyclopedia. You ask a question, and it synthesizes instructions for you to follow.
But an AI agent is given a budget, a goal, and access to your accounts.
Yeah, it's like a personal assistant. You don't tell the agent how to navigate a website. You just give it the objective, and it autonomously manages the subtasks required to actually execute the transaction for you.
It transforms the AI from a passive retrieval system into an active execution engine. Alphabet actually highlighted a real-world application of this during the call regarding their partnership with Ulta Beauty.
Right, they have integrated agentic commerce directly into the Gemini app and AI search.
The user experience is completely contained. A user can discover a cosmetic product, ask the AI to compare it against alternatives based on their specific purchase history, apply a promotional code, and completely check out.
All without ever leaving the AI chat interface. The traditional concept of bouncing to a brand's standalone website is bypassed entirely.
This is a profound architectural shift for the internet. But, to deploy this at a global consumer scale, Alphabet had to solve a massive unit cost problem.
Oh, because generating an AI response requires significantly more compute power and therefore more electricity than returning a traditional blue link search result.
Exactly. If every Google search becomes an agentic AI transaction, the computing costs would literally bankrupt the system.
However, they announced they have reduced the cost of core AI responses by more than 30%.
Which is crucial for profitability. The mechanism behind that 30% reduction is fascinating.
Yeah, they aren't just negotiating shipper electricity rates, right? They achieved this through engineering and algorithmic breakthroughs, specifically the implementation of highly specialized router models.
Right, so instead of sending every simple user query to their most massive, power-hungry foundational model, a smaller, highly efficient router model evaluates the prompt first.
It decides in milliseconds whether the query requires the massive compute cluster or if it can be handled by a much cheaper localized edge chip.
And by routing tasks dynamically like that, they drastically reduce the average cost per query.
That engineering efficiency is what makes the consumer rollout financially viable, and consumer adoption is definitely accelerating. Alphabet noted they have surpassed 350 million paid subscriptions globally.
Driven predominantly by YouTube Premium and those Google One tiers that grant users access to these advanced frontier AI models.
People are increasingly willing to pay a monthly premium for personal agentic capabilities. It's a huge shift.
It is. We also have to look at the physical manifestation of these AI models in the real world through their other bets segment.
Waymo.
Waymo, yes. Their autonomous vehicle division just crossed a massive operational threshold. 500,000 fully autonomous driverless rides per week across 11 major U.S. cities.
500,000 rides a week without a driver? Waymo is really the ultimate proof of concept for their compute infrastructure.
It is. To safely navigate a physical vehicle through unpredictable urban environments requires processing environmental data with near-zero latency.
It's so easy to overlook the other bets division when Google Cloud is generating $20 billion a quarter, but Waymo represents the tangible realization of their billions of dollars in AI research and custom silicon development operating in the physical world.
It's the physical endgame of all this compute.
Wow. We have covered a massive amount of technical and financial ground today. Let's synthesize the core dynamics of this paradigm-shifting Q1 2026 earnings report for everyone listening.
Sounds good.
First, Alphabet is seeing robust top-line operational growth of 19% in constant currency, and the undeniable engine of that growth is Google Cloud, fueled by an 800% surge in enterprise AI demand.
Yep, that's point number one.
Second, while the headline numbers touted an 81% leap in net income, we have to recognize that this figure was heavily distorted by $37.7 billion in unrealized gains from their venture equity portfolio.
Right. The core business is healthy, but the profit doubling is really just an accounting reflection of the broader stock market.
Third, the defining constraint of the modern tech era is physical infrastructure. Alphabet is allocating nearly $190 billion to capital expenditure, navigating massive compute constraints and securing power.
They are literally building the physical foundation for the next decade.
And fourth, the fundamental architecture of the internet is shifting from information retrieval to agentic execution. AI is no longer just telling us what to do. It is actively executing multi-step commerce workflows on our behalf.
Which leaves us with a really critical implication for the future of the digital economy. Just something for you to mull over after this episode.
Let's hear it.
If Alphabet's agentic vision fully materializes, and our personal AI assistants begin communicating directly with corporate AI assistants to negotiate prices and execute transactions, what happens to the traditional website?
Oh, wow.
If humans are no longer manually navigating web pages or scrolling through search results, will humans even look at traditional ads in 5 years?
That is the trillion-dollar question.
Or will the entire discipline of marketing shift from attempting to persuade human psychology to reverse engineering and persuading a user's AI algorithm to pick your product?
A complete rewrite of the rules of digital commerce. Fascinating. Well, thank you for joining us on this deep dive. Keep questioning, keep learning, and we will catch you on the next one.